Dear students, this is Mangalore University BBA first semester paper Corporate Accounting 2. We are in 19th session. We have been discussing problems on internal and external reconstructions. Let's go to take on problem on internal reconstruction. Well, read the problem carefully. Given below is the summarized balance sheet of Rebuilt Limited as on 31st March 2011. Here you are given a horizontal balance sheet, left side liabilities and right side asset items. And here in equity part, first we begin with authorized and issued capital. 12,007% preference shares of rupees 50 each. Within a bracket, note preference dividend is in arrear for 5 years. So that is 6 lakh. 15,000 equity shares of rupees 50 each, that is 7,50,000. Total 13,50,000. And you have loan, that is 5,73,000, which is a long-term liability. And you have you have current liabilities, trade payables and other liabilities. And if you come asset side, you have building costless depreciation. So this 4 lakh is book value, so which is after depreciation. So this is a book value after deducting depreciation. Plant at cost less depreciation. So this is a cost value of plant, which is nothing but book value after deducting depreciation. And here you are given current assets. Before current assets, so here you are given intangible assets, trademarks and goodwill at cost rupees 3,18,000. Current assets, that is inventory 4 lakh, trade receivables 3,28,000. And here you have accumulated loss or negative balance of P&L account, that is profit and loss account debit balance. So this profit and loss account debit balance is a fictitious asset, that is 4,51,000. Now we need to go for internal reconstruction because there is a loss, accumulated loss of 4,51,000. We need to reconstruct this company. The company is not earning profits short of working capital, and a scheme of reconstruction has been approved by both the classes of shareholders. A summary of the scheme is as follows. First one, the equity shareholders have agreed that their 50 shares should be reduced to 2.50 by cancellation of rupees 47.50 per share. They have also agreed to subscribe for 3 new equity shares of rupees 2.50 each for each equity share held. You need to understand it first. Okay. What is said here? The equity shareholders have agreed that their rupees 50 shares should be reduced to rupees 2.50 by cancellation of rupees 47.50 per share. So here we are reducing the paid up capital of equity shareholders from 50 to 47.50. Then they have also agreed to subscribe for 3 new equity shares of rupees 2.50 each for each equity share held. So one more thing you need to observe here. They are sacrificing this rupees 47.50 per share, okay? But along with that, they are being issued new shares. How many new shares? They have also agreed to subscribe for the 3 new equity shares. Equity shareholders agreed to subscribe new equity shares. How many new equity shares? 3 new equity shares for each share held. So every share will get 3 new equity shares of rupees 2.50 each for each equity share held. Okay. The preference shareholders have agreed to cancel the arrears of dividends and to accept for each rupees 50 share 4 new 5% preference shares of rupees 10 each plus 6 new equity shares of rupees 2.50 each, all credited as fully paid. understand it. The preference shareholders have agreed to cancel the arrears of dividends. So here is a dividend arrear to preference shareholders. They seem to be cumulative preference shares where you need to give their preference share dividend which is accumulated, okay, but they are ready to sacrifice it. Preference shareholders have agreed to sacrifice the amount of dividend they are supposed to receive. They are sacrificing it, they are giving it up, and to accept for each rupees 50 share 4 new 5% preference shares of rupees 10 each plus 6 new equity shares of rupees 2.50 each, all credited as fully paid. So with a condition, so they are giving up this dividend arrear, right? But for a condition, what is the condition? To accept for each rupees 50 share 4 new 5% preference shares of rupees 10 each plus 6 new equity shares of rupees 2.50 each, all credited as fully paid. So here is an agreement. So they are convinced to give up their dividend arrears, but what is that condition? They are given new preference shares. Instead of old preference shares of face value rupees 50, they are getting a new preference shares of face value 10. At the same time, they are also getting 6 new equity shares of rupees 2.50 each. For every preference share held, they are going to get 6 new equity shares for rupees 2.50 each. So these preference shareholders, the old preference shareholders, so these preference shareholders, these 12,000 preference shareholders, so they are going to get a new preference shares. So this old preference shares will be cancelled. The old preference shares of rupees 50 will be cancelled and they'll be given new preference shares. New preference shares of rupees 10 each. That is a face value. And they are also going to get, these preference shareholders are also going to get equity shares. How many equity shares? 6 equity shares for every one preference share. So they are going to get 6 equity shares for every one preference shares, and that at the rate of 2.50. That is a face value. Well, next third one is lenders to the company for 1,50,000 have agreed to convert their loan into share, and for this purpose they will be allotted 12,000 new preference shares of rupees 10 each and 12,000 new equity shares of rupees 2.50 each. So here lenders, that means here you have loan, right? So how much loan you have? You have 5,73,000 loan. So the lenders of this loan, okay, so they are agreed to cancel certain amount of loan for in exchange of, so they are ready to cancel certain amount of loan in exchange of preference shares and equity shares. How many preference shares? 12,000 preference shares and 12,000 equity shares. That means these lenders are getting 12,000 new equity shares and preference shares, so that they are going to give up certain amount of loan. Lenders to the company for rupees 1,50,000. So they are ready to give up this 1,50,000 loan in exchange of getting fresh 12,000 preference shares and equity shares. Next, the directors have agreed to subscribe in cash for 40,000 new equity shares of rupees 2.50 each, in addition to any shares to be subscribed by them under section A above. So this one. So that means, so the directors of the company, they have subscribed to the new shares. So they have subscribed to the new shares in cash for rupees 40,000. So that means they have paid 40,000 share application money in order to subscribe new equity shares for rupees 2.50. Next, of the cash received by the issue of new shares, rupees 2 lakh is to be used to reduce the loan due to the company. So here, out of the cash collected from issue of shares, so you have issued shares, right? By issuing shares you have collected cash. So out of that cash you are using 2 lakh to repay the loan amount. So you have loan amount here. So in this loan amount, you have settled certain amount of loan by issuing equity shares and preference shares. And you're also paying 2 lakh loan to the lenders here. So you are paying 2 lakh loan to the lenders here. Next, to equity share capital cancelled is to be applied. First one, to write off the debt balance in the profit and loss account, and to write off rupees 35,000 from the value of the plant. Any balance remaining is to be used to write down the value of trademarks and goodwill. So here, the equity share capital cancelled is to be applied. That means here, the equity shareholders are sacrificing 47.50 per share. So this will go to, so this reduced liability is considered as capital reduction. So this will go to capital reduction account. So in that reduced capital, or what we call it, the surplus. So capital reduction account, we are using that capital reduction account credit balance in order to write off the debit balance of profit and loss account. First, we need to write off this loss. If you find any loss in the balance sheet, first that has to be written off. You need to reduce it. You need to remove it first. So because you are internally reconstructing the company, that means you need to remove the loss first. So you are just writing it off. So you are using the capital reduction accounts balance for writing it off, 4,51,000. Then you are using the surplus or capital reduction account credit balance to write off the goodwill. So write off the plant. You are undervaluating this plant. You are undervaluating this plant by how much? You are undervaluating this plant by 35,000. So you are going to use that surplus in order to undervaluate this asset by 35,000. And if there is still balance, so if you are left with any additional balance, that can be utilized for writing off intangible assets, goodwill, so trademark and goodwill. So you can make use of that amount, which is the remaining amount of the balance, to write off intangible assets. So that is what the scheme. Any balance remaining, so that is all right. So that is what the scheme. Next, to show by journal entries how the financial books are affected by the scheme, and prepare the balance sheet of the company after reconstruction. The nominal capital as reduced is to be increased to rupees 6,50,000 for preference share capital and rupees 7,50,000 for equity share capital. So this is, you need to change the authorized capital. So it has to be shown in balance sheet. Well, this is only about authorized capital. You need to change the authorized capital. So just you need to mention that in balance sheet. That will not have any impact on your balance sheet figures. It's simply for the sake of showing it. Okay, but you need to follow these points in order to reconstruct the company. So it's simple. You have to go by the scheme. First, you need to pass journal entries in the book of Rebuilt Limited. So you pass the journal entries in this way. So you draw a table, particulars, debit items and credit items, and here just follow the scheme. We need to follow the scheme. So we have to pass the journal entries according to the scheme. So let's go to see one by one. First one is, the equity shareholders have agreed that their rupees 50 share should be reduced to rupees 2.50 by cancellation of rupees 47.50 per share. So that means we are cancelling these rupees 50 shares. So in the place of that, we are introducing rupees 2.50 shares. That means we are reducing the face value. So it is a kind of scheme where it's an alteration of share capital where we are reducing the face value and paid up value together. Okay. So we are reducing the face value. As we are reducing the face value, you need to cancel the original shares. You need to cancel the old shares. In the place of them, you need to introduce the new shares. Any difference amount, that will go to capital reduction account. So capital reduction account is a temporary account that is opened for the sake of internal reconstruction. So if there is any reduction in the capital, So that will increase the capital reduction account. So that will increase the balance of capital reduction account. So that will be credited to capital reduction. So what happened here? We had equity share capital of rupees 50 each. That is, if you look at the balance sheet, we had 15,000 equity shares of rupees 50 each. We had 7,50,000 equity share capital out of 50,000 equity shares at rupees 50 each. So these equity shares are being cancelled now because their face value is changed. So we are cancelling these equity shares and introducing new equity shares. That is what. So cancelling the old equity shares. So how to cancel it? So normally equity share capital has credit balance. If you debit it, it is going to be cancelled. So to reduce any liability item, you need to debit it. To reduce any asset item, you need to credit it. So we are reducing this liability item. Equity share capital is a liability item, right? So, or it's a capital item. To increase the capital, credit it. Decrease the capital, debit it. So we are debiting it. That means we are removing this. Earlier it was credit balance. By debiting it, we are removing it. So equity share capital account debited 7,50,000. 2. In exchange of what? We are issuing new shares. That is for rupees 2.50. So we are going to credit it because it is being added newly. It's a new capital which is being added. So we need to credit it. So to equity share capital account 2.50 each, 15,000 equity shares into 2.50 will get 37,500. And here is a gap, the difference amount. So that difference amount will go to capital reduction account because it's a surplus. So our liability is reduced to this extent. 7,12,500 is a reduced liability which is considered as surplus, and that will go to capital reduction account. So once this is done, let's go to second one. So we are going to the second point. The preference shareholders have agreed to cancel the arrears of dividends and to accept for each 50 share 4 new 5% preference shares of rupees 10 each plus 6 new equity shares of rupees 2.50 each are created as fully paid. So here what happened? So first thing is that they are giving up the accumulated dividend. So they are giving up the accumulated dividend. That is one thing. And secondly, so these preference shareholders are cancelling so the old preference shares. They are ready to cancel these old preference shares. These old 7% preference shares of rupees 50 each are being exchanged by 5% preference shares of rupees 10 each. So for that we need to pass the entries. And one more thing is that so they are being issued equity shares also. So they are being given equity shares. How many equity shares they are getting? 6 equity shares. So here these 7% preference shareholders, they are going to get 5% for new preference shares for every one old preference share. So in the place of one old preference share, they are going to get 4 new preference shares. And they are going to get 6 equity shares for every one old preference share. So how many old preference shares were there? So there were 12,000 old preference shares. There were 12,000 old preference shares of rupees 50 each. For every one preference share, they are going to get 4 new preference shares. That means for 12,000 preference shares, they are going to get 48,000 preference shares, 48,000 new preference shares. In the place of 12 preference shares, they are going to get 48,000 new preference shares. This is what it said, right? 4 new preference shares of rupees 5%. So 4 new preference shares of 5%, rupees 10 each. So 48,000 preference shares are being issued newly. So they are going to get 48,000 new preference shares at rupees 10 each. That is 4,80,000. So this is what the new preference shares are being issued. That's the reason you are crediting it. So 5% new preference shares. And you are debiting it because you are cancelling the old preference shares. So these old preference shares are completely cancelled. In the place of them, new preference shares are being issued. For every one preference shares, you're going to get 4 preference shares. That's the reason it is 12,000 into 4, that is 48,000. 48,000 into rupees 10, 4,80,000. And these old preference shares are also getting 6 equity shares. 6 equity shares. The equity shares are being issued at 2.50. Okay, the face value of new equity shares is 2.50, everywhere common. So these preference shares, preference shareholders, the old preference shares are getting 6 new equity shares at rupees 10 each. At rupees 2.5 each. It is here 2.50. Well, 6 new equity shares of rupees 2.50 each. So every one preference share is getting 6 new equity shares. That means 12,000 preference shares are getting how many equity shares? That is 72 equity shares. 12,000 into 6, that is 72. 72,000 equity shares. So they have to get 72,000 equity shares at rupees 2.50. 72,000 equity shares at rupees 2.50, that will be 1,80,000. 72,000 into 2.50, that is 1,80,000. So this new preference share and this new equity shares are issued and considered amount is credited. So that means what? So here if you see, all credited as fully paid. So they are credited as fully paid. It is considered that the amount is fully paid. So the shares are issued, new shares are issued, and preference shareholders are not supposed to pay for these shares. Their amount is already considered fully paid. Their amount is considered fully paid because they are sacrificing this much. They are sacrificing 6 lakh old preference shares. So with this, their amount is settled. But this 6 lakh is not sufficient to settle this amount. It requires more. How much it requires more? It requires 60,000 more. That is a balance. Then how do you settle it? So that 60,000 will be settled by the capital reduction account, by debiting the capital reduction account. Because in this capital reduction account, you have excess balance. You have the balance of 7,12,500. You can use this balance to settle the amount supposed to be received from preference shareholders, because preference shareholders are giving up this old preference shares of 6 lakh, and in the place of that they are being issued new equity shares and preference shares. They no need to pay for it. They need not have to pay for it. Their amount is considered as fully credited, but it is credited by what you need to debit for crediting it. So one thing is their old preference share is debited, but that is not sufficient. You can also debit the capital reduction account by 60,000 for the balancing amount. So now it is fully settled. Next is, there is third point. If you go through lenders, so lenders are agreeing to give up 1,50,000 of their obligation. So lenders they have agreed to convert this 1,50,000 by subscribing 12,000 new preference shares and 12,000 new equity shares. So it is simply, lenders means they may be debenture holders or loan given by bank. Okay, for this 1,50,000 they are going to get, so they are not going to get cash for it. So it doesn't mean that, it means that we are repaying this 1,50,000 by issuing preference shares and equity shares. How many preference shares? 12,000 rupees 10 preference shares and 12,000 rupees 2.50 equity shares. So it is just conversion. So we are converting this 1,50,000. Actually we have more loan, but to the extent of 1,50,000 we are paying it by issuing these two shares. So by that, so this 1,50,000 will be settled. So this 1,50,000 is debited because earlier it was credit. We need to remove this. We need to reduce this 1,50,000. That's the reason we are debiting it. So loan account debited 1,50,000. So loan is a liability. So by debiting, you can remove the liability. So loan account debited 1,50,000. Two, how it is settled? By issuing fresh preference shares, 12,000 preference shares of rupees 10 each, that is 1,20,000. 12,000 equity shares of rupees 2.50 each. 12,000 into 2.50, that is 30,000. So 1,20,000 plus 30,000 is equal to 1,50,000. So to the extent of 1,50,000, your loan is reduced. Next, next is if you look at the scheme. If you look at the scheme, the directors have subscribed rupees 40,000, 40,000 worth of cash. So they subscribed equity shares of rupees 2.50 each. Okay, so they subscribed equity shares. They subscribed 40,000 equity shares. This is number of shares. Okay, directors have subscribed 40,000 equity shares of rupees 2.50. That means how much? 40,000 into 2.50, that is 1 lakh. So 1 lakh share application money is paid by the directors, board of directors. So they have also access to the equity share capital. They have subscribed 40,000 equity shares at rupees 2.50, that is 1 lakh. So what is the entry? Journal entry is that whenever there is subscription of shares, the share application money will be received by your bank. So debit the receiver, bank account debited, because this share application money is received by the bank. 1 lakh share application money is received by the bank. So bank account debited to equity share application money account 1 lakh. And you don't keep the share application money in this account. You will transfer that into share capital account. The very next entry is equity share application money account debited to equity share capital account. Finally, it should come to equity share capital. So this is the equity share capital subscribed by directors, 40,000 equity shares of rupees 2.50 each. So now there is nothing left in share application money. The amount which is credited here, debited here. So now this share application money goes to equity share capital account, 1 lakh. So that's it. Next what happened? Of the cash received by the issue of new shares, rupees 2 lakh is to be used to reduce the loan due to the company. So see, if you look at the loan here, it is 5,73,000 loan. You have 5,73,000 loan obligation. Out of this 5,73,000, you have settled 1,50,000 by issuing new preference shares and equity shares. But still there is some loan left, right? But you are here paying that loan. You are paying 2 lakh loan by cash. So you are paying this loan by cash. So where is the source for that cash? The source is you have issued equity shares, so that you have collected cash. So cash is there. Okay. So you can make use of the cash for paying the loan amount. How much loan amount is left? There is 2 lakh loan. You are paying that 2 lakh loan by cash or bank. So your bank is going to give it, credit the giver. And loan is debited because this much loan is being settled. You are settling the loan means you are reducing the loan amount. That's the reason you need to debit it. Loan account debited, it's a repayment of loan. Loan account debited to bank. So bank is repaying the loan. Your 2 lakh loan is settled. So what is the source for this bank? You have issued fresh equity shares. That means you have received. Here you have received. Here you have received 1 lakh, and here also by issuing equity shares, you have received 1,12,500. So you have bank balance. Okay, you can pay from bank. You have source for it. So that is settled. Then the final entry. So this one is very important. Where Now you have capital reduction account credit balance. You can make use of that credit balance for writing off the fictitious assets and undervaluation of other assets. What is said in the problem? So what is said in the problem? So they are saying to write off the debit balance in the, so this amount is utilized for which amount? The equity share capital cancelled is to be applied. So how did you get the capital reduction account balance, credit balance? You got the capital reduction account credit balance by cancellation of equity shares only, right? So if you look at here, so you got this capital reduction account balance from where? You got this capital reduction account balance by cancellation of equity shares. So this cancellation of equity share, nothing but capital reduction balance, is utilized for writing off the debit balance of P&L account. So your job is to write it off first. It's a loss. It should be removed from your balance sheet. So you use this surplus for removing the profit and loss account debit balance, and you are also using this for undervaluation of the asset. You are reducing the value of this asset plant, and if anything left, if still there is balance, you can use that for reducing this goodwill. That is goodwill, writing of the goodwill. Well, that is what it is said here. Okay. To write off rupees 35,000 for valuation of plant, any balance remaining is to be used to write down the value of trademark and goodwill. So let's go to do it. Journal entries. What? So capital reduction account, it's a temporary account. So we should not keep any balance in it. So we need to debit it immediately. So at the end, you need to debit it. So it's a closing entry. Always you need to debit the entire balance of capital reduction. The entire balance of capital reduction. So you can take the net. So wherever capital reduction credit is there, you need to add it. Wherever capital reduction debit is there, you need to deduct. So capital reduction account credit balance 7,12,500. And here you have capital reduction account debit balance. We use this for settling down the preference shares, the money to be received from them, right? So we used it for it. 7,12,500 credit minus 60,000 debit. And the remaining is 6,52,500. So in capital reduction account, you have 6,52,500 credit balance. And we are using this 6,52,500 credit balance to write off profit and loss account. This is a debit balance of P&L account, asset side. So we are writing it off fully, 4,51,000. It is completely gone. Then we are using 35,000 for undervaluation of the asset, undervaluation of plant. So we use it. So you are debiting the plant. When you debit the plant, sorry, you are crediting the plant. When you credit the plant is an asset. When you credit any asset, asset value is reduced. So by crediting plant, you are reducing the asset value by 35,000. So by crediting profit and loss account, it is just nullified. Profit and loss account is completely nullified because it had debit balance earlier. Now we are making it credit, so it is fully gone. So profit and loss account 4,51,000 debit. Here profit and loss. Here profit and loss 4,51,000 credit. Debit and credit got cancelled, and here still we have balance, right? 4,51,000 is gone for writing of profit and loss account. 35,000 is gone for writing of plant, but still we are left with some amount. How much? We still have balance of 1,66,500. If nothing is told in problem, we could have transferred this 1,66,500 to capital reserve account. If the problem is neutral about writing of the intangible assets, we could have transferred that into capital reserve account. But here it is clearly said whatever is left, any balance is left, that has to be used for writing of trademarks and goodwill. So we are using that for writing of trademarks and goodwill. 1,66,500 is used for writing of trademarks and goodwill. So nothing is left in capital reduction account now. It is fully utilized. So these are the journal entries we need to pass for internal reconstruction. So once you are done with journal entries, we can move to balance sheet. So it's a vertical balance sheet. You are supposed to prepare only vertical balance sheet. Okay. So in this vertical balance sheet, we have notes. So for this, it's a final answer. Okay. So if you want to see the breakup and all, you need to go to the notes. First, you better prepare the notes. So normally note is required for share capital. Note is not required for all the items. So we keep notes for major items. Note is required for share capital, and we use note is required for tangible assets and intangible assets, and note is here used for cash and cash equivalents. We are using only 4 notes here. That's enough. Remaining things are mentioned directly when first one is share capital. So in this share capital, as it is given in the problem, we need to change the nominal value, that is authorized capital. How to change the authorized capital? It is said in the problem, it is given in the problem, right? Authorized capital. So it is said here, the nominal capital as reduced is to be increased to 6,50,000 for preference share capital and rupees 7,50,000 equity share capital. It has to be increased, which was reduced. Okay, it has to be the authorized capital to be increased. So how are you increasing that authorized capital? In this way, as it is given in the problem, 6,50,000. 6,50,000 preference shares of rupees 10 each. That means how many preference shares? 6,50,000 divided by 10. That is 65,000 preference shares. 7,50,000 equity share capital at rupees 2.50 face value. That means how many equity shares? That is 3 lakh equity shares. 3 lakh equity shares of rupees 2.50 is equal to 7,50,000. You can just divide this by face value. You will get number of shares. Okay, so you need to get the total of it, that is 14 lakh. It has to be shown here in the notes. So it has to be simply shown here in the notes. Okay, it will not come to the balance sheet here. So we can directly take the share capital, which is paid up capital. We should consider only issued and paid up capital for balance sheet, but in note we need to show it as per Schedule 6 of Companies Act. Then we go to issued, subscribed and paid up capital. So how do you get this issued, subscribed and paid up capital? It's so easy. Okay, but you need to mention 2 kind of capitals here. One is equity share capital and another is preference share capital. Now you have introduced a new equity share capital of face value 2.50 each, and new preference share capital, 5% preference share capital. Earlier it was 7% preference share capital of rupees 50 each. Now you have issued a new 5% preference shares of rupees 10 each. So the old capital is completely removed. So if you look at the balance sheet earlier, so we had 7% preference shares. Earlier we had equity shares of rupees 50 each. It is completely removed. We don't have any old capital now. We have new capital in the place of this old. So what is that new capital? So that new capital is mentioned in the note here. One is equity share capital and another is preference share capital. Equity share capital at the face value of rupees 2.50 and preference share capital, a new preference share capital, that is at rupees 10 each. It's here, a new preference share capital at rupees 10 each. So how do you get it? How did you get this 1,80,000 and 60,000? How did you get this number of equity shares? It is simple. Okay, what you need to do, you come to journal entries. Here you come to journal entries. Wherever equity shares are credited, take the total of that. So wherever you find equity share credit, so you go to add it. That's it. Here we have equity share 37,500 plus, here we have 2 equity share capital 1,12,500 plus, here we have equity share capital 1,80,000 plus, here we have equity share capital 30,000. Then here also we have equity share capital 1 lakh. So wherever you have equity share capital credit, take the total and you will get the total. How much? You will get the total equity share capital. You will get 4,60,000. How did you get this 4,60,000? By adding credit balance of equity share capital in journal entries. The total of that will be 4,60,000. And you know the face value, that is 2.50. Divide this 4,60,000 by 2.50, you will get 1,80,000. So this is 1,80,000. 1,80,000 number of shares. 1,80,000 equity shares of rupees 2.50 each. And how did you get this 6 lakh? Again, you go to journal entries, and wherever there is preference shares credit, you go to total it. Wherever you have preference share credit, okay. So where you have, here you have 5% preference share, 4,80,000. Take it, 4,80,000 plus, where else? Here you have 5% preference shares, 1,20,000. 4,80,000 plus 1,20,000. So that's all, right? So that's all. That is 6 lakh. 4,80,000 plus 1,20,000. That is 6 lakh. So 6 lakh new preference shares are issued. 6 lakh. So you know the face value, that is rupees 10. 6 lakh divided by 10, 60,000. 5% preference shares of rupees 10 each. That's it. Okay. And here you need to total it. That is 10,60,000 share capital, which will go to balance sheet. Share capital 10,60,000. Well, then you go to non-current liabilities, where long-term borrowings, which is nothing but loan. So this long-term borrowing is what? Either debenture or loan. So here we have loan, right? How much loan we have? We have earlier, how much loan we had? Opening balance of loan. Opening balance of loan we had 5,73,000 loan we had. In this 5,73,000 loan, we have settled 1,50,000 loan by issuing preference shares and equity shares, and 2 lakh loan is settled by cash. So that means 3,50,000 loan is already settled. So you need to find out the balance now. 5,73,000 loan opening balance minus 3,50,000 loan already settled, and the remaining is, it's here. So remaining loan amount, it is directly written here. Long-term loan 2,23,000. 2,23,000 is a remaining amount. Well, next we go to current liabilities, third one. In this current liability we have trade payables and other current liabilities. So note is not required for it. We directly take it from balance sheet. So we have not done anything with respect to this, right? So directly we can take it from balance sheet. Trade payables 2,07,000 and other liabilities 35,000. 2,07,000 and 35,000 we have directly taken from balance sheet because no change is made with respect to them. Trade payables and other current liabilities. So that's all about equities and liabilities. Let's get the total of that. That is 15,25,000. And now we can go to the asset side. In this asset, we have two portions, non-current assets and current assets. In non-current assets, normally we have fixed assets and long-term investments. Here we don't have any long-term investment. We have only fixed assets. In that fixed assets, we have two portions, that is tangible assets and intangible assets. And we have made some changes with respect to tangible assets and intangible assets. That's the reason we are going to open notes for it. So we're going to write note for them. So tangible assets. So what tangible assets we have? If you look at the balance sheet, we have building and no change is made with respect to building. What is given in the balance sheet? Building 4 lakh. We have taken the same 4 lakh here. But with respect to plant, we have reduced the value. So there was an undervaluation of plant, right? That is 35,000 is reduced. What was the plant earlier? What was the value of plant earlier? If you look at the balance sheet, plant 2,68,000. So minus 35,000, we need to undervalue it. So if you just reduce the value by 35,000, the remaining balance, remaining balance of plant is 2,33,000. 2,68,000 minus 35,000, 2,33,000. So get the total of it, you will get the tangible assets 6,33,000. And when it comes to intangible assets, we have reduced the value of goodwill. So whatever the balance left for capital reduction account, we use that capital reduction account balance for reducing the intangible assets, that is trademark and goodwill. It was earlier 3,18,000, and we have reduced. How much we have reduced? We have reduced 1,66,500 here. We have written it off. So the balance is how much the balance? Intangible 1,51,500. So we need to take them into the balance sheet. So here we have taken that into the balance sheet. So 6,33,000 tangible assets, 1,51,500 intangible assets. And finally we go to the current asset. In that inventories we have not made any changes. Take the same from balance sheet, 4 lakh. Trade receivables also we have not made any changes. Take the same from balance sheet, that is 3,28,000. So we are going to take the same old balance. So no changes are made with respect to them. And as far as cash and cash equivalent is concerned, we need a note because we have made some changes there. So in cash and cash equivalents, take the opening balance of bank. So cash or cash equivalent is nothing but bank. Okay, so take the opening balance of bank, and wherever you have debit balance, add it. Wherever you have credit balance, deduct it. Debit balance indicates cash comes to bank. Credit balance indicates cash goes out. Cash is paid by bank. This is cash received by bank. So opening balance, how much? So if you look at the balance sheet, you find the opening balance there. What is the opening balance? Opening balance is here. Bank opening balance. You have here you have cash and cash equivalents. So there is no opening balance in bank. If there is opening balance, you need to take it. Otherwise, no opening balance. So, but here there are some transactions. So wherever bank is debited, you need to add it. That is receipt. So here bank is debited. That is receipt. We have received from issue of shares. Okay, 1,12,500. That is a receipt. Next, here we have 1 lakh receipt. Minus we have paid 2 lakh. To repay the loan, we have paid 2 lakh, right? So wherever we have debit balance, add it. Wherever we have credit balance, deduct it. So you will get the net. That is cash and cash equivalents, 12,500. It's a net amount. So that will go to balance sheet. Balance sheet credit side, 12,500. And if you total it, it should match with equity and liability. So 15,25,000 here and 15,25,000 here. Your balance sheet is tallying. So this is about internal reconstruction. So in internal reconstruction, you need to follow the scheme of reconstruction, and wherever there are adjustments with respect to alteration of capital, you need to adjust that. Wherever there are adjustments with respect to long-term loans or trade receivables, payables, so you need to adjust it. And if there is capital reduction account credit balance, that can be used for writing of the fictitious assets and undervaluation of other assets. Hope you have understood this problem. Thanks for watching. Thank you.